Macrame Wealth Management, we come with no pretense. Financial advising, making money make sense.
Hello, welcome. Wanted to take this time to have a discussion on the national debt crisis that's ahead of us and see what we can do about it. So today we're going to talk about a view on the impact of fiscal stimulus and national debt. There's a website that shows the scary reality that we're in today. If you go to usdebtclock.org, you'll see a running tally of our national debt that's based on some algorithms and whatnot that's probably just there to depict it, how it's growing, and all these other things. And it's overwhelming to look at. So this is just a snapshot that I took around a week ago. And right now, the current U.S. national debt is $25 trillion. That's trillion with a T, so 12 zeros. The current federal deficit is 2.9 trillion, and the U.S. gross domestic product is 21 trillion. So that's what our country puts out every year as far as an output, 21 trillion. So we have more debt than how much we're generating each year as a country. Total personal debt, also $20 trillion. So we have quite a bit individual debt and debt as a country. So there's a lot of red on this screen. There's a lot of things to think about. So when we look at a scary situation and we have something that is scary in front of us, like my daughter's closet at night where she might get afraid that there's something behind it. So what should we do? Well, we believe that we should shine a light in those situations and be the light in this world and in this situation. So we're going to take a look behind the curtains to see, should we be scared of what's going on or not? Martin Luther King Jr. has a great quote. He says, "We're not the makers of history, but we are made by history." And so let's start by looking at history when it comes to the national debt to see where we were and where we are today. So here we are, 120 years of U.S. national debt from 1900 to 2019. And you see that for many years it was very low, and it wasn't really until the late 70s and to the 80s where things really started to get out of hand. So it started to grow fairly exponentially at that point, and then even more so after 2008 and 9 took off. And that's where we started to run more of a deficit as a country, and that's where it's gone since. So we know we're accruing debt, and debt at a pretty large pace, fast pace. So the question is, well, where is the money going each year exactly? So here's the 2020 budget, $8.2 trillion U.S. spending. So 22% of the U.S. budget goes to healthcare. So plainly, specifically, Medicare is the majority of that. 22%. 19% is to pensions, government pensions, and included in this is Social Security. So 19% of that 8.2 trillion. 16%, it goes to education, 12% to defense, 8% other category, 6% goes to welfare, 4% to protection, transportations for general governments 3, and the interest that this debt that we've accrued is 6% of where our spending is going. So we know where the spending is going, but how is our economy doing? So we talked about GDP, our gross domestic product. It's how we rate how much output our country is producing. In 2019, it was 19.2 trillion. Personal consumption, 64% of our GDP. So how much you're spending ties into our GDP as a country. Domestic investment, this is specifically commercial investment. If you're upgrading and investing in things commercially. Government consumption, 17% when they put out a job request, for example, and offer grants to do something. That would be all government consumption dollars. Net exports of -3%. So for this section, you take your exports and you subtract it from your imports. Or actually, the other way around, imports subtracted by your exports. What -3% means is that we're exporting less than what we're importing. So that's actually reducing our gross domestic product for that sliver. So we put both of these things together. We say, okay, well, the U.S. national debt, and we're going to look at 1947 on to 2019. So we're going to look past both world wars and say U.S. national debt's going up there in the blue. Here's GDP in the red. So GDP's gone up at a fairly linear rate. It hasn't been as exponential as the national debt has gone up. So that's fairly interesting. So why is the national debt going up at this clip? So I mentioned before surplus or deficit. So let's look at that a little bit. Here's the U.S. federal spending that's gone on in that same time frame. So we see if it's above the dates, that means that the government was in a surplus. So it's no different than you or I creating our family budget. And if we have more money coming in than what we're spending, that's a surplus. So any of those years that's above the dates, we're in a surplus. Any of the years that we're below the dates, we're in a deficit. If there's a deficit, that means that national debt number goes up, because that's how we fund a deficit, is by taking on more debt. So we see that until the 80s, we were running a surplus, which is why our national debt level was fairly low. And then since then, we've mostly been running a deficit. Or I might have said surplus. We're running a deficit, except for those years between 97 and 2002 or so, where there was also a surplus. But since really 08-09, that's where a major deficit came into play, and we haven't really recovered from that. And now we're adding to that deficit even more so with the CARES Act and additional government spending to get through this next national emergency. So interestingly enough, I wanted to look at these dates and say, well, is there anything that we can take away from this that we can correspond it to maybe from a world war? So I just put on here, let's look at the different world wars that were going on. So Korea, Vietnam, Cambodia, Zaire, Lebanon, all those wars were being fought while we were in a surplus. So a war doesn't necessarily equate to running a deficit, which I think a lot of people sometimes ask me, well, is it war spending? Well, no, it's not necessarily war spending that's putting us into this. Really, where it seems to have hit the hardest was the Great Recession. So the Great Recession brought in that massive decline, and we never have had a surplus year since then. So we put all these together on one chart and start to paint a picture. We want to see where we're going long term. So federal deficit surplus is now in the yellow. So as it dips into the dates, that means that deficit has hit. So we see the 09 there. And once it dips down, you see that corresponding blue line really start to take off a little bit more on the national debt amount. So this is how our country is doing. This is the U.S. national spending. How are we as a people doing? That's an interesting question. So if we take we as a people and take that national debt amount and divide it by the number of households to say what's your debt load that you're carrying as a U.S. citizen, here we are, 1947 to 2019 debt per household. And isn't this an interesting picture? Because we saw the national debt really taking off like a hockey stick with this exponential growth, but that's not the picture here. We actually see national debt has come down per household from where it was in the late 40s. Interestingly, it did come down quite a bit until the 70s and then has been creeping back up. And since 08-09, the debt per household has been coming down. National debt hasn't been coming down, but debt per household has been coming down. So what that means is right now we're actually at a debt per household, we're better off now than we were in the late 40s when we make the debt a per household increment. And how can this be? So what's going on behind the scenes? Well, the main thing that's happened during these 70 years or so is growth. U.S. households shown here from 1947 again to 2019, and this is just natural population growth as well as people coming into the country and adding to our numbers. So by having a higher population and the national debt not growing faster than this has grown, has meant that we're now at a less debt per household multiple, which is kind of interesting. So if we say, well, we're growing, we know that piece, but how about assets? How are individuals doing as far as accumulating wealth? Well, that answer would be interesting because the answer is very well. So U.S. private net worth here in the red, it shows that growth has really taken off since the 80s as well. So what that means is privately held net worth. This is people's retirement accounts. This is people's equity in their homes. This is trust accounts that you might have inherited or created. That is the U.S. private net worth, and we see it took a dive in 08-09. I'd imagine if we get 2020's numbers, we're going to see some of that get pulled back as well a little bit during this decline. So overall, though, it looks fairly similar when we put that on the graph as well to the national debt dollar amount. So now that private net worth is shown there in that lighter blue, and the national debt is shown in the darker blue. And you can see they both have had, especially in the early 2000s, the same growth pattern, same as the 90s there. And if it weren't for that major setback in 08-09, it would probably look fairly similar to the national debt amount. So these are all publicly listed and available information to look at. So some questions to ask is the debt a problem? So there's points to be made. The debt is larger than our national GDP. So we have more debt than what we're producing as a country. Our interest of $574 billion as of fiscal year 2019, that's a large number. There's $574 billion of interest every year. That's 6% of our budget. There's no end in sight to balancing the budget, as Congress needs to get on the same page to be able to do that. And interestingly enough, what's going on behind the scenes too is 26.5% of our national debt is owned by the U.S. government. So it's debt that's pulled from one account to pay for another account, predominantly pulled out of the Social Security bank to pay for other government services, government departments and whatnot. That's being repaid. But I thought that was kind of interesting. So how will this get fixed? Just like any of us having a budget that's out of whack a little bit, that we've accumulated too much debt, whether that be on credit cards or car payments or whatnot. So there's two ways to do it. You can make more money, increase your revenue, or you can cut what you're spending. And the cuts have to come from the budget. And without a balanced budget being put out there, that's not likely to happen right now. So more than likely, when this is attached to the political agendas of the upcoming presidential elections, they'll talk about reducing that debt load through increased revenues specifically. And what kind of revenues? Where our government makes most of their money on taxes. So where does our federal tax revenue come from exactly? So federal tax revenue, 50% comes from you and me, individual income taxes. The other 36% comes from payroll taxes. So there's 7.6% or so that's coming out behind the scenes when you get your paycheck, or if you're lucky enough to be self-employed, you can double that number. And now you've got 15% in payroll taxes. That's the employee and the employer portion. Corporate income taxes are separate. So corporate income taxes are specifically, we're talking about companies that are C corporations. They have their own tax rate. And they pay out, used to be a 35% tax rate and was recently reduced to a 21% tax rate as of 2018. The other three buckets would be Federal Reserve earnings, so the earnings they get from issuing treasuries and notes and bonds, 2%. Excise taxes of 2%. When you make a purchase, those are the excise taxes. And other would be 3%. So this is currently where the federal tax revenue comes from. Has it always looked this way? Well, no. Historically, if we look back from 1945 to 2018, individual income taxes, which we just saw was 50%, has kind of wavered. So in this graph, the dark blue is individual income taxes. So we see that in 1945 or so, it was 40%, and now it's 50%, and it's wavered all throughout there. Some years 50, some years 40. That's more or less where it's come from during the years. Corporate income tax is the next darkest blue. That was a much higher amount, so that was around 36% back in 1945, where we just saw it was much lower, 7% today. But payroll tax is more than made up for that. It was much, much lower back in 1945, where today we saw it was about 36%. And then the last one, other, which is that highest white area that goes all the way up to 100%. Excise, estate, and other taxes used to be 20% of the government revenue. Now much less, closer to 9%. So when we talk about individual income taxes, that's 50% of the government's revenue. That might be the main area that's looked at in the future when they're talking about budget, balancing the budget, getting more revenue in so they can pay down this debt. Maximum historical tax rates from 1913 to 2019 are shown here. This is the maximum bracket. So interestingly enough, our country has not always had taxes. We've started off with taxes based on what you owned, what you purchased, and then 1913 there was the income tax that was introduced at 7%. So that started it off, and then soon after that World War I hit and taxes jumped way up to fund the war. So we hit 77, 75% tax rates in there, came back down in the roaring 20s, but then jumped up again when World War II happened, again funding war efforts, and even creeped as high as 92, 93% as a maximum tax rate. And since then, luckily, it has come down quite a bit. So this is ordinary income tax rate. This is your wages. Some of Social Security money can be taxable. Pensions, all that falls under ordinary income taxes. There is another tax rate to consider and to look at, which is the capital gains tax rate. So capital gains is on the sale of capital goods. So that's, you sold a property, there may be capital gains taxes. You sold stock or mutual funds or index funds in a non-retirement investment account or a brokerage account. There's capital gains taxes on that. So if we look at both of those rates and take away World War I and II out of the equation, because those are kind of anomalies, it seems, and we say, okay, so let's start 1943 to 2019, ordinary income tax rates in blue, capital gains in red. So capital gains has more or less been somewhere between 20, 25%, 15%, somewhere in there, where ordinary income has had a lot bigger range, as high as 92, 93%, down to where we are today at 39%. So that's quite a bit of difference. So if we say, okay, the government may look at this area when they're looking at trying to reduce the debt, and they may say there's actually historical precedents that the ordinary income tax rates should be raised, because we have many years where we had a higher tax rate and we functioned just fine. Look here. So if that were to happen, and we take a year like 1947 to examine, Well, here we go. 1947, married filing jointly federal tax bracket. So you can see here, this looks a lot different than today's brackets. For one, there's a lot more brackets. The other part is the numbers are a lot higher. It goes all the way up to 91% in this particular year for any income that's over 200,000. So just to remind you how we read a tax bracket is we say if we made $10,000 in 1947, the first 2,000 would be taxed at 20%. The next 2,000 would be taxed at 22%. The next 2,000 would be taxed at 26%. And that's how you look at this. This is specifically married filing joint tax bracket. But this is 1947 bracket, and it's 1947 dollars, which isn't really going to tell us how this would apply today. So if we took these dollars and say, well, okay, how has inflation been in the last 70 years? And let's look at these dollars with inflation. Well, here we go. In the last 73 years, inflation has averaged 3.63% through some years of high inflation in there in the 70s and 80s. So here's what tax brackets would look like with today's dollars. So really, the 91% bracket wouldn't be people making over 200,000, it'd be people making over 2.7 million. Otherwise, it is still a higher bracket. So if you're making $200,000 a year, you're approaching the 50% bracket. So any additional bonus you get, would be somewhere around a 50% of that you'd have to give to the government. So if we compared 1947's bracket with today's dollars in it to today's bracket with today's dollars, how does that look? And we can take a little snapshot and just say, well, let's put some of it up. We couldn't fit all of it on this slide. And say, well, how do these compare? So if you made, in that same example, $200,000 today, you're in the 24% bracket. You're not going to pay 32% until you hit 321,000, where if it was a 1947 tax bracket, you'd be paying approaching 50%. So if we graph both of these and say, well, how do these look like comparatively? That shows an interesting story. So the difference between the blue and the red is the greater taxes that would be applied if we had this bracket today. So you'll see that the greater distance between the blue and the red, the greater the change would be for us as individuals being subjected to this. So the place with the greatest change is right around 300,000. So if you're making around $300,000, you're in the 24% bracket, where you'd be close to 60% bracket if we applied a 1947 tax rate. And of course, if you're making large numbers, if you're making $1 million to $3 million, then you're paying significantly more in taxes on the 1947 bracket as well. So this is looking at both of the brackets, but how are we doing individually? So if we say, well, what's the median, mean income, things like that. So 2018, the median income is $61,000 in the U.S., meaning the average income, which consists of 80% of the population falls under that. 90,000 is the mean income. So we're going to talk a little bit about the difference between median and mean in that. The 250,000 income is the top 1% of the population. So somewhere around 80% make 61,000, over 1% make 250,000. This is based on 2018. So let's talk about median and mean, what this means when we dive into the data and compare it. So we said 61,000 is the average using a median, 90,000 is the average using a mean. This is talking about income. Mean, when they talk about a mean average, it's an arithmetic average. It's taking all the numbers, adding them up, and then dividing by the number of data points. So in this example here, we've got 3 ones, 2, 3, 4, 9, 9, 9. What you see is the total is 45. You divide it by 9, because there's 9 data points and the average is 5. So one person says the average of those numbers is 5. Well, the other person's using the median. Median means the middle average. So in that same example, you don't add it up or anything, you just take the middle number. So the middle in this one is 3. So one person says, well, the average is 5, and the other one says, no, the average isn't 5, the average is 3. Why do we typically use median numbers? Well, median tends to eliminate the outliers. So it says, well, they're, those ones that are really at the top or really at the bottom, they don't really show what the average person is going through. We need to take the middle person. So we need to be cognitive of those differences because it does matter. Why it matters. So let's look here. Averages at a glance. We've got 2018 median. We just looked at this. The median income 61,000. So let's say 62,000. Keep in mind that's taking away the outliers. The U.S. mean income is 90,000. That's without taking away the outliers. There's a 45% difference in those numbers. That's a fairly significant difference. But when we look at net worth, and net worth is a little bit harder to come by because that's census data. So we had to look at a 2016 data point there. So U.S. median net worth, 94,000. U.S. mean net worth, so not taking away the outliers, almost 300,000. That's a 217% difference. That's a lot more than the income difference. So what this is saying is there's some discrepancy between income and between net worth as well. So let's look at some of those outliers that might be causing this. In 2018, there were 211 households with wages over $50 million a year. 211, that is approximately 0.000012% of the population. In 2016, the average median net worth was $94,670. The net worth is being skewed in the mean and median, that mean being closer to 300,000, by who? All these billionaires that we hear about every day. Jeff Bezos being on the top of the heap. These are all 2019 numbers. 114 billion. He's actually closer to 150 billion now, and that's even after the divorce where he had to give a lot away. Bill Gates, 2019 number, 106 billion. Warren Buffett, 80. Mark Zuckerberg, 70 billion. Larry Ellison and Larry Page, 65 and 55 billion. The Forbes number of billionaires is significant. There's hundreds of billionaires. And the interesting thing is, if you are a single billionaire and you spend $100,000 a day and have no growth on your account whatsoever, you just park it in the bank and it just keeps up with basic inflation, you can spend that $100,000 every day for 27 years before you run out of money. That's how much $1 billion is. So there's some discrepancy going on, a lot more on the net worth side of the equation than the income side. So how are we, the people, doing? This U.S. private net worth number in red here is the median. So we're talking about how the average person is doing. If we took the mean number, it might actually look a little bit more similar to the U.S. debt number that we looked at before. So the next thing to question, so if the government's going through this and there's someone like me that's working for the government saying, how are we going to balance the budget? Well, we just established that one place to look at is potentially U.S. private net worth, which has been adding a lot of dollars lately. So that could be a great piggy bank to tap into. Or it could also be some of the income discrepancy, but the net worth is really shouting out because it has had exponential growth that matches the national debt. So where's the net worth held? So here's where people are holding their net worth. Number one, rental property equity. Interestingly, number one, the highest area. Number 2 was annuities and trusts. Number 3 is stocks and mutual funds. Number 4 is equity in one's own home. And number 5 is retirement accounts. So these are the areas when the government says there's a lot of private net worth. Where do we need to start attacking to move money from their pockets into our pockets so we can balance this budget? Here are the 5 categories that's going to predominantly be looked at. So when we put all this together, there definitely seems to be a correlation on the government saying, well, we need to start moving private net worth and making it government property through taxes. So what are the main takeaways of all this? So number 1 is when taxes rise, and they will rise, income will be targeted and assets will be targeted. So when people are talking about it, when you have political candidates running for office and they're talking about things, start to pick up on if they're talking about going after ordinary income or going after capital gains. If they're talking about going after capital gains, they're really trying to target assets. They're trying to target that discrepancy of saying there's a lot of privately held net worth. So that means they're going to start targeting equity in real estate. They're going to start targeting company stock, estate tax, things like that. Income will be targeted if they're talking about ordinary income, but that's going after the mass population. That's that historical tax rate we looked at from 1947. So these are things that are going to be attached as wages, pensions, Social Security, annuities, all those things. So really listen when they're talking to understand how it's going to apply to you. So key takeaway number 1, understand your tax brackets and fully utilize that bracket. So here's an example just to give you a snapshot. Here's a 2020 married filing jointly couple. So hypothetical 67-year-old couple. They have $50,000 in earned income. Let's say hypothetically it's from pensions that they still had. So $50,000, when we go over and look at that tax bracket on the right, we see they haven't hit $79,000 or so. So they're still in a 12% bracket. When they do their taxes, they use a standard deduction. Standard deduction means we take that $50,000 and we reduce it by a standard amount. So we're able to reduce it by $24,800 because that's the 2020 standard deduction for them, plus another $1,650 because they're over 65. So once you take away those two numbers, their adjusted gross income is now $23,550, which is fantastic. That means they're going to predominantly pay about 10% taxes, and they're very happy about spending only about $2,500 on taxes that are due for that $50,000 in income. But here's the thing. If we look to the right, they have $55,000 of earned income left in that 12% bracket. So there's $55,000 that they could have earned or could have made and still been in a 12% tax bracket. Well, why is that important? That's important because now they have 3 choices ahead of them. Number 1 is they can do nothing and they can just celebrate the fact that they only had to pay $2,500 in taxes. That's great. The second thing they can do, though, is they could sell in $55,000 worth of gains in stock or a property and pay 0 in additional taxes. What does that mean? Give it to me in English, you might say. If you had a $100,000 stock and that $100,000 stock is now worth $150,000, you could sell it if you were in their shoes, sell it and not have to pay any in taxes on that $50,000 gain because of the tax bracket that they're in. So that's interesting because otherwise you would sell it and that $50,000, you'd pay 15% capital gains rate. So you'd end up having, about a $7,500 tax bill due. In this case, they would owe 0. So they were just able to save $7,500 in taxes. So that's option 2. Option 3 is they could convert, because not everyone has stock outside of a retirement account or an investment property. But option 3 is they could convert that $55,000 from their IRA and move it into their Roth IRA that maybe they had or maybe they opened. Doesn't matter if they're working or not. In doing so, you're going to lock in that 12% rate. So they are going to have to set aside, about $6,000 to pay the ordinary income taxes come due next April. But they're never going to have to pay more than 12% on that money. And all the growth that comes from that $55,000 is all going to be tax-free in the future. So those are great options. So really understand your bracket and fully utilize it. Key takeaway number 2 is be diversified. So we always talk about diversification when it comes to stocks and bonds and alternatives and gold and all the other things that come up. That's not what we're talking about here. That is important to be diversified. But what Warren Buffett said about diversification is that diversification is protection against ignorance. And I would argue that we're all fairly ignorant about what the government is going to do in the future. But what we do know is that where our assets are being held. We talked about real estate, company stock, mutual funds, trusts, annuities. Be diversified by not having all your eggs in one basket. If all your net worth is held in equity in real estate, consider diversifying it out of real estate partially. Because if a law change, if they end up saying, well, we're going to specifically go after people that hold real estate because that's the number one area where net worth is, and we're going to target capital gains rates, you might not be as happy with your positions anymore. Same with you have all your net worth in company stock or a pension. Think about ways that you can diversify out of that. Would be my suggestion on how to be diversified given upcoming tax changes. Number 3, key takeaway. Understand how taxes are paid on what you own. Everything generates different tax liability. So if you own equity in real estate, you might be paying ordinary income on some of it. You might have capital gains. Understand what those rules are. Know how things are being held. Is it investment property or is it property that you own and live in? If you own company stock, understand how you have ordinary income generated from it and capital gains. All these have different tax treatment. If you have stuff, know how the tax is paid so you can know how to best diversify from a tax liability standpoint. Key takeaway number 4 is to have advisors in your corner that you trust to keep up with things. These are really interesting times to be in. It's very important to have people that know these kinds of things and can plan around them for you, such as the little things like the 12% bracket to be in to realize it at 0% capital gains. And there's any number of things like that that good advisors can help you with. So who should you have on your advisory team? Well, a financial advisor, and specifically a fiduciary financial advisor, someone that is looking out for your best interest and not just trying to sell you things, is very important. Having a good accountant to work with, because sometimes we're doing calculations for some of those tax treatments, and we want to make sure we really hit the target on the nose with. And last is an estate planner. You want to have someone that's good, that knows the rules, and can walk you through that as estate law changes may happen, as well as that's a high target for potential income for the government. But all that to be said, we looked at a lot of negative things, but there are reasons to stay positive. For number 1, we're entering into a recession, more than likely. If we have 2 negative quarters of GDP growth, it'll be an official recession. And increasing taxes would only stall the economic recovery. For example, they just announced they're going to keep the Federal Reserve rates down for a few years just to keep the economy stimulated. So that's positive that we might have a window here of good opportunity to make some changes. Number 2, interest rates are at historic lows, which should help in refinancing our debt obligations. We have a lot of debt, but if interest rates are low, you can refinance at a lower rate sometimes, and that's positive. And number 3 is the more billionaires we get, the bigger the target grows on them. I hope that we all have the ability to be a billionaire in the future, but as long as they're continuing to grow their net worth at such a more exponential rate, there are going to be more people that look to them as the solution for some of our debt. So those are all positive things. And the last reason is you have the ability to be proactive and make smart decisions now. So that's a great thing. General Patton said, never tell people how to do things, tell them what to do, and they will surprise you with their ingenuity. I believe that 100%, and I think that we'll get through this and hopefully make the best decisions we can now. So thank you for watching. Thank you for listening. If you have any questions, please feel free to send them to me. Andrew.kermay@raymondjames.com will be the email that'll get to me, or give me a call at any time. I'll be happy to answer any questions or talk through these things. Thanks for watching again, and have a great day.